In this episode, we dive into the lure of ETFs with daily distributions, a strategy that seems too good to be true. We'll break down the mechanics behind these products, uncover hidden risks, and expose why chasing daily payouts can lead to portfolio blindness. Are these ETFs a revolutionary cash flow tool or just financial sleight of hand? Let's find out after the bell. Hey, we're here. There's no screen.
Wow.
That was so scripted.
I know. The teleprompter was going too fast. I couldn't keep up. I hit it too soon.
The teleprompter that everybody wants.
Oh my God. It's so funny. I had to hit the back button. I'm like, oh God, I got this all messed up. How are you guys? Good to see you.
Good
to see you, Lex.
Good. All right, this topic, everybody, is interesting. Now, this is a Mark special, I think, a Mark Phillips special, right? So you kind of follow this stuff, I think, to a large degree, Mark. These ETFs that have, I'm going to say the wrong words, but I think of them as structured, bundled kind of products that offer a return as a bundle of sorts, right? So we'll break all that out, but that's how I refer to them as. Do you have a better?
I think that's a great analogy, honestly, and I think that is one of the benefits, right? Before we get into ragging on these whole things, it's like the fact that in a nice little tradable product that anyone with a Robinhood account or a Tradier account can, get access to, that's pretty incredible. And a lot of this has exploded with the relatively recent ETF Act that allows for active management within these things. Sure. So you can put together any combination of option strategy and throw a ticker on it now. And that's what people are doing.
Yeah. Okay. All right. So I know you have, maybe you don't even have any pros to these things, but you have a lot of cons, right? So how do you want to delve into this thing? Which one, is there a particular one that we can talk about, or is this general?
So maybe we'll talk about a class and the ones that are focused on distributions, but yep. I actually truly believe there are some pros. And I think one being packaged and very tradable, that's a benefit, right? Tradable liquidity, in and out ability for investors, all, one single transaction. There's something to that. There is some diversification in these, right? They are, the classic ETFs that originally packaged S&P together, these do package securities together and get some diversification aspects. So there are, benefits. And I think some of these can even be well done. One, I guess, class that I think maybe to focus on would be the ones that are distribution focused. Mm-hmm. There's, call it a class of buffer products. There's the covered call products. And then there are ones that are even, a flavor of that covered call class that's just looking to generate a lot of distributions, mm-hmm. By selling calls, spreads, whatever that might be. Newest one being this daily dividend ETF that's, I think, coming online sometime in May.
Okay. So what does an investor or trader do to partake in these? Is it simply buying the ETF, calling it a day?
Yeah. And, you buy it like any other stock, and many of them actually have explicitly in their objectives weekly distributions, monthly distributions, daily distributions, whether it's a target or whatever. Mm-hmm. But that's where some of the complexity comes in. There are benefits to, the structuring of, distributing capital back to investors. That's, there are reasons why people might want that type of thing. But it gets a little complicated because these things are writing options, they're selling calls and whatnot on these big tech names. Mm-hmm. But most of the return in investor capital is a tax class called return of capital, because they're actually giving you your money back. Okay.
So it doesn't sound sexy to me. Sorry.
No, it's not particularly sexy, because, when you think of, a lot of people frame the covered call as an income generator, and that's a whole other asterisk of whether that's truly income. But mm-hmm. they look at this strategy as something that they want to be getting money back. Right. But realistically, it's their own money back, which creates a weird tax status where it actually reduces your basis on that share. Okay. So your basis is going down, meaning when you sell it, you could actually have a capital gain if this thing doesn't, stays steady.
Right.
And so you're converting something that, could be a dividend payment, could be a short-term capital loss on an option, into a basis reducing distribution.
Okay. So what?
I've lost everyone on the tax stuff.
Yeah, is one of those is one of these types of ETFs the BOXX, the bot? You know that one?
That's a different ETF, and that's actually kind of interesting. That's one designed to do box spreads and capture the interest rate in the options market.
Okay, so people can use that. Like, let's say you have excess cash in your trading account. In hold on a second. And you have excess cash, and the clearing firm isn't giving you interest on your extra cash. You could technically use this box to generate for yourself interest rate return. Is that correct or not?
Yep. I don't know what their distribution cycle is, but yeah, and I believe there's also like a tax advantage to using the options to capture that rate, that it might not be taxable in the same way as if you had it coming in coupons from a bill.
Right. Okay. Got it.
Again, not tax advice. Yeah, I might not give financial advice, but I definitely don't give tax advice.
Yeah, right. No kidding. I just try not to pay them. Oh, I didn't say that. Jason, I know you're sleeping over there. Do you use this stuff at all? What? Huh?
No. I don't. Most of the time, I find that ETFs, like the ones that Mark is talking about, can be a little bit systematic. You guys call them structured products, and it is kind of like that, but they're very systematic. They're not very discerning at all, and sometimes I kind of question the edge. As far as like daily distributions, it's kind of like, again, as Mark alluded to, you're really just distributing your own capital. You might as well put it in a high yield savings and take money out every day. And it won't expose you to as much risk. So, I mean, overall though, but I do agree also with Mark that packaging this into something nice and neat and tradable where anybody has access is very cool. I mean, as somebody, both Mark and I tried opening up hedge funds and, even trying to get an ETF is very, very difficult. And there's so much regulation and stuff. So to actually kind of cut through a lot of that for retail investors or investors overall to just invest in this strategy or invest in what I see is really cool.
Okay. So takeaway then, the ease of use for an investor without having to really understand, an option strategy and doing it yourself is a pro feature. It's good just for ease of use, right?
Imagine having to execute your own box strategy all the time. It'd be a pain in the neck to have to roll that.
I did that in my former life doing box strategies. I did it all the time. We did it in the market making days to generate, credit balances, right? So you get paid on your credit balance as needed. So you could do your own management. Well, the clearing firms figured that out and said, hey, you're going to get charged a tax when you create a credit, balance using these boxes. So they figured that out, because it was taken away from their VIG. But using the BOXX, there's nothing they can do there. You're just owning an ETF that's paying you the similar type product. Or
you click 4 little buttons and hit enter, and you're good.
That's it, right? So that is a beautiful thing. However, I think, Mark, you and I talked about this in the past. If you do it yourself, you probably have access to better returns and a more customized, obviously, mechanism if you understand how to create these on your own.
Absolutely. That is my saw that I will keep on grinding. But like something like a box, for example, even I would prefer to put my money in that than actually execute a box strategy, because that's like a highly efficient means of doing that.
Right.
Once you start getting into covered calls, to Jason's point, it's systematic and doesn't use indicators or doesn't, judge the price of the option. That just whacks a 25 delta every month or whatever their mandate is.
Yep.
And even things like, some of these distribution focused ones, you got to understand that you're earning kind of like risk-free rate of return money with left tail equity risk. So, the trade-off in there is not great. And you can do much better on your own with, a buffer product too, right? Like you get slightly better numbers than you might if you're just buying an off the shelf version.
What's a buffer product? Is that the same thing?
So these are these like protect and participate products where you get, the first 5% of upside and you're protected between, whatever on the downside.
Okay. So what do we think then? Are these ETFs revolutionary for cash flow purposes, or are they a little bit of a financial sleight of hand? Because I kind of mentioned that in the beginning, or neither for that matter. What are your thoughts? Either one, guys.
Totally depends on the individual, of course. But in general, I think it's really important to be aware that like if you're getting something that's very distribution focused and it's ultimately changing your tax status in a way that might not be advantageous down the line, compared to say executing something yourself and getting the benefits of say short-term losses in a covered call strategy, if stocks ripping, like that pass through is actually beneficial to the investor. Or if you're doing SPX products, so it's boring, but there's a lot of tax complexity and differentiation between these. And I think that's where the, hidden aspect is. And at the end of the day, just better returns from doing it on your own and better levels.
But you got to be a tinkerer in trading, right? To do it on your own, to do it well on your own. So you got to be, on deck. As it were.
It does require some active management, or you can, work with someone like Jason or I.
What is that a plug? Was that just a plug for harvestedfinancial.com and damfunds.com?
He tripped over himself when he talked about mine, but that's okay.
Oh my God. The two competitors. Yours is too hard to say.
We're not. I don't consider Mark a competitor. I think anybody who brings risk controls through options like Mark or I is a positive to the marketplace.
Yeah.
I'll even extend that to the ETF products. Like the options awareness is a net good thing, I think.
Yeah.
I think investors should look hard at what they're getting and make sure it's appropriate for them. But like, the overall increase in, at the end of the day, any liquidity is good liquidity. So like, that's additive and constructive in the overall ecosystem.
Yeah, I agree. All right. What else? Any other of these that are poking around? I love the box one. I'm just reading about it now online here. Really, really interesting. I know probably the firms who don't offer a lot of interest rate on excess cash don't love that product. I'm guessing, right?
It forces them to have to give interest on cash.
Yeah. So, all right. Ruben, hi. Yes. What do you need, sir? Or ma'am? I'm not sure, but Ruben. Anyone know Ruben? Is that one?
I don't know him. Let me put that better. It wasn't like a I do not know him.
Yeah.
I don't recognize that name.
Okay. Terrific. So if you have a question, just fire it away. We'll answer before we leave. Okay. What else were you? Where was I? Box. Yeah. So that's a good one. I'm going to look at it. What are some of the others? You said there's another one that is a structured product for a covered call strategy. What do you know the ticker for that one, Mark?
One of the bigger ones is FEPI.
FEPI.
And they sort of own a basket of the top biggest 15 tech names and write covered calls on them.
So, give me an example. NVIDIA, Amazon, Tesla.
Yeah, I thought there were
Micron, Netflix, Meta,
right?
Salesforce, Adobe.
Okay.
Yeah.
Wow.
Doesn't JP Morgan have one?
Who?
The JP Morgan has like the JEPQ or whatever, right?
Yeah.
That has like a huge. They have a big one, right? It's like 20-something billion in assets.
Okay. Yeah. So I don't know the name of that one. This one that Mark referred to as FEPA, FEPI.
FEPI, yeah.
Yeah, and it looks like it's 15 equally weighted high liquid tech stocks. Apple, Amazon, Meta, Alphabet, Microsoft, Netflix, NVIDIA, and Tesla. I don't think that's 15, but there's some others. But those are, God, that's kind of a neat little product, and it pushes out a covered call strategy on that basket of stocks. Is that accurate?
That's correct.
Okay.
NVDY, I know, is NVIDIA.
Okay.
So they have a covered call thing on NVIDIA.
The
Wow.
problem with doing covered calls on tech, and I've been doing a bunch of research, like specifically on like Tesla, because I think it's kind of the extreme example, is that like you're giving away so much of the upside.
Yeah.
You know, even if you're selling the 25 delta call, like over the last 10 years, if you sold the 25 delta covered call on Tesla,
Yeah.
you win about 72% of the time, right? That's fairly close to what you'd expect, right? But the right tail is so powerful that you literally make half as much as if you just own the stock. That like the kurtosis, the skew, the like fat tails of the distribution, particularly on the upside and in tech names, like is nowhere near compensated for in the winners,
Right.
you know, compared to what you're selling and earning in cover call premium.
Sure. So having said that, I think I totally agree with that. Maybe the strategy of a structured product in an ETF like this on the whole tech sphere, especially these tech stocks, is I totally agree with you on that one. Maybe it's better in stocks like IBM or way more staid stocks that just are still great stocks, but they're not going to just bomb up one day because of a great new technology, you know, something like that. Maybe a little different basket of still tech, but not the high flyer tech fellas.
Well, the issue with something like IBM is that the volumes are not as high on IBM as they are in NVIDIA. So if you put a covered call, you know, you put a bunch of covered calls on an IBM, you know, ETF, you're going to shift the vol curve like crazy. You know, the vol curve is going to depress real fast.
So are you talking about the option volume isn't as great in IBM? IBM used to be one of the highest volume option stocks on the CBOE floor.
It's nothing compared to like NVIDIA or Tesla.
Amazing how that changed. See,
yeah.
I'm dating
NVIDIA and
myself.
Tesla are 1 and 2 every single day.
It's amazing.
Yeah, Xerox doesn't trade anymore. Did you know that, Lex?
That was by the way, that was my original pit. I went into the Xerox pit on
Nice. How is your Sears Roebuck stock going?
I'll tell you what, I have a carbon copier.
Where's your fax machine?
Oh my God.
Where's your carrier?
Yeah, it's amazing. No more IBM, huh? Next thing you're telling me Intel isn't a good stock either.
Well, that has
recently had quite a trade in Intel.
I am still in my Intel position. I told you the 11-year-old got me in at $18.82. It's trading 24-ish, give or take. Still have about 50 weird kind of combos left on it. It was a home run. So just saying.
Nice.
That was a nice one. All right. I think we got to go. Anything else on these daily distribution ETFs? Alluring, we agree. Good for some people who don't want to kind of do handiwork and just sort of get return. But some of these things can kind of cap one side or the other. So be careful of that, right? And most important, talk to Jason and Mark if you want someone to do it for you, right?
I think a good summary of the ETFs, maybe this will be our short thing, is it is designed to optimize liquidity, not to optimize returns.
Okay, smarty pants. I like that. Very good. All right, awesome. Very good. Don't forget to sign up, hub.trader.com. Visit these two guys. Adayam Funds. Did I say that right? That's pretty good.
Adayam, yes. It's
AdayamFunds.com, harvestedfinancial.com. Mark and Jason, the two market mavericks. And what else? Send me an email, lex@trader.com, if you want to talk further. All good, guys? And Mark, what else do we have to do?
Happy trading.
Happy trading.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.